Good morning and welcome to the Real-Time Solutions webinar. We'll be discussing financial planning and investing during uncertain times today. My name is Jennifer Harmoning, President of the Burnsville Chamber of Commerce. This webinar series is brought to you by the Apple Valley, Burnsville, Hastings, Lakeville, and River Heights Chambers of Commerce. And we thank you for joining us this morning. We have three presenters with us this morning, so we will jump right in. Our three presenters are Bob Bayer, Laura Basballe, and Chris Casey. We're going to start first, pardon me, while I get to the right slide, with Robert Bayer. Robert, you want to join us this morning?
Sure, good morning. Thank you. Thank you for having me. One of the first questions that we want to tackle is, how should you invest now? And first of all, let me say that the things that we talk about here probably are going to be more general in nature and not specific to any one particular individual. That said, how should you invest now? First, I think it'd be a really good time to do a gut check, self-check. Like, how do you make your investment decisions? How's the recent market turbulence caused you to act or react with your money? Do you understand the appetite for risk in your time horizon? These are important things, but really comes down to what drives you to make the financial decisions that you do. For example, how many of us back in February had or wish we had 3 to 6 months worth of emergency reserves, either for your home or your businesses? It's not that sexy by any means, but investing in emergency reserves is important to your financial success, so you can start from a position of strength. However, since the markets are attractive right now, it may make sense to do a couple of different things, such as rebalancing your portfolio to the desired level of risk that you're willing to take. Revisit that. We've had a nice 11-year run-up in the market, and so rebalancing is probably a really good idea to keep in line with your risk tolerance. A couple other things that are critical is increasing the level of your retirement contributions. Everything's on sale right now and it's priced much more attractively. So if you have the wherewithal to increase your contributions in your IRAs or 401ks, retirement plans, especially when you have the company match, increasing those contributions by a few percentage points over the long haul can really do yourself some good. Additionally, since the markets are down right now, it may make sense to think about converting some of your IRA assets to Roth IRAs. This can be done both inside or outside your employer plan, and purge some of the taxes out now while making the opportunity to buy things on sale while the market's still a little depressed. Something specifically that we do at Stonebrooke Wealth Management is with clients is really to glance backwards and learn from our past, but really focus forward. Meaning that the traditional investments are, mutual funds and ETFs and typical stocks and bonds that have been around for quite a while. But there's opportunities that are coming that many investors aren't really aware of. And I want to use the example of Microsoft. For example, back in 1986, if you had $5,000 invested in Microsoft, you probably wouldn't even be on this call because you'd have over $10 million in your portfolio. So it's great to look backwards and see these kinds of statistics, but what do we see when we look forward? And there are many things that we like to focus on as a slice of a client portfolio. And we look forward to things like 3D printing, autonomous vehicles, adaptive robotics, blockchain, Internet of Things, genome therapy, cloud computing, and so forth. We're reminded of it when we're on the highway and we see a Tesla drive by, where 10 years ago that didn't exist. And 3D printing, for example, that didn't exist. There are things that are coming that we can be looking forward to take a slice of your portfolio and say, you know what, I want to be on the front end of something and not always looking backwards at my historical rates of return, although they're important. But we want to really be focused on the road ahead with part of our money. So for the short time that we have together, in conclusion, do a gut check first on how you're behaving with your money in good times and when times are challenging. Review your appetite for risk and then rebalance if necessary. If you don't have an emergency reserve built up with 3 to 6 months worth of income, get one, start working on it. Otherwise, you're investing now and you may end up having to tap into your investments when emergencies arrive. Double check your time horizons, not only towards when you want to retire, but you've also got life expectancy, and that could be a good 30 years after you retire. So you want to make sure you're looking at more than just one of these signposts that you pass in life. And then look for opportunities that are available now inside of your existing plans, increasing your retirement contributions, Roth conversions, tax minimization strategies, and so on. And then, of course, look forward to the things that really are coming into the future, as I previously mentioned. So now's the time to really beginning to look backwards and ahead at the same time. So Jennifer, thank you for the time.
Thank you so much, Bob. That was very informative. And we will jump right in so that we have some time for Q&A at the end. I put a message in the chat. If you want to any attendees want to open your chat feature, you're welcome to submit questions and we'll try to get to those at the end. Our next presenter is Laura Basballe, and we'll jump right in with Laura here.
Well, good morning, everyone. I want to provide everyone this morning listening in some common sense thoughts about how you can look at your finances and investments in light of the COVID-19 economic disruptions. So I've got a slide deck that we'll start going through in very quick order. So don't worry about taking notes about the slide deck. Anybody that would like to see these, we will send out a copy. We'll have Jennifer forward this to everyone after today's presentation. So don't worry about having to take notes down. So I put together a slide deck because visuals tend to be easier to illustrate important concepts. So sit back and just absorb the images on the screen while I talk about a few important things. And again, feel free to reach out to any of the guest speakers or your own circle of trusted financial contacts to discuss your questions in greater detail. So first slide here is things that matter, things you can control, and then where they meet, it's what you should focus on. I tell my clients all the time, there's no point in worrying about things that you can't control, like the direction of the stock market. What matters is you being proactive in building the type of portfolio that can weather a wide variety of market conditions and that you can leave alone to do what it needs to do. Next slide. So the behavior gap. Studies have shown time after time, investors frequently don't see the same returns as the actual underlying investment. We call this the behavior gap, and investors oftentimes are their own worst enemies because it's so hard to stay focused and logical during periods of market volatility like what we've seen over the last 2 months. The market doesn't care what your goals are, doesn't care what your time frame is or your appetite for risk. It just keeps marching on. Next slide. So what are the things that you do have to invest? I tell clients it's not always about what your investment dollars or your portfolio is. Having a strategy to wisely invest your time and energy and improving your skill set are often critically important just as much as whatever is in your investment accounts. Things you can do to improve your job skill set so that you can make more money and have greater lifetime cumulative earnings. So all of these things are very important in addition to just whatever is in your investment portfolio. Next slide. Days or decades. So you can see on the left-hand side, the slide speaks for itself. That feels an awful lot like what we've gone through just in the last 2 months. And it shows that extreme volatility. But your investment time horizon, much like Bob mentioned a few minutes ago, could last 10 years, 20 years, 30 years, even longer during your entire period of retirement. So we try to help clients understand that even though there's day-to-day volatility, we want to keep your eyes on the longer term market trends over decades so that you can stay focused on your goals. Next slide. Behavior versus market timing. I like to tell people, tune out the financial porn of the media and stay focused on your long-term goals. You know, The number one determinant of having a successful portfolio is developing good investor behavior. Work with your trusted financial circle to develop a portfolio that meets both your short and long-term goals, and don't worry about trying to get the latest stock tip or anything. That really does not matter in the long term. Next slide. So we see this a lot, that people always anchor themselves to the past and they want to do what seems to have worked in the past. And sometimes it just causes a lot of accidents and messes in your portfolio. Many investment principles are timeless. It's always a good idea to review your goals and your accounts at least annually to make sure it's still a good fit for your overall time horizon, whether there's been any economic changes, good or not so good, and then also as your goals change. Next slide. Oh, Jennifer, oh, yep, there we go. So, cycle of market emotions. There's an old Wall Street quote some of you may have heard. Bulls and bears make money, pigs get slaughtered. So, and we see this time and time again where investors that don't develop good long-term investment behavior, typically they get excited, they put more money in at the top of the market, they get scared when we go through periods of extreme volatility, and they sell at the bottom of the market, and then they wonder why they don't see the long-term returns like what the stock market indexes do. So again, this is really all about helping you develop good long-term investor behavior. Next slide. So the big mistake, one of the things that I've worked with in my clients over my 23 years of being a financial advisor is really helping them take that moment to pause so that they don't make a knee-jerk reaction like selling at the bottom of the market. And really, we help them always tie everything back to what their short-term goals are, what their long-term goals are, and just helping them just put things in perspective so that you're not as prone to periods of panic during periods of market volatility. Next slide. Your goals matter. It couldn't be more simple to say. Many people like to compare their performance with what did the stock market do? What did their neighbors do? My family, my coworkers. Again, tune out that financial porn. The only goals that matter are what's unique to your situation. And no two clients have exactly the same situation. Next slide. Diversification. This slide, again, really speaks for itself. A portfolio, you need to have distinct asset classes. 4 rectangles and 2 triangles is not good diversification when you should have a rectangle, a circle, a triangle, and an asterisk in your portfolio. We see this happen too often when investors select their 401k choices. If you're not sure, work with your plan provider or work with your trusted financial advisor and develop a personalized portfolio that best fits your goals. Next slide. Current reality compared to your goal. I tell investors you're almost always better off riding out the market volatility instead of trying to time the market. Investing, it's like taking an airplane flight. Even though there may be periods of turbulence, sometimes extreme turbulence, turbulence has never ever caused an airplane to crash. Stick with your long-term plan. Next slide. Let's get you organized. If your finances and investment accounts look like the disorganized pile on the left, set aside some time to do some serious KonMari getting organized, or work with someone in your family, or work with your advisor, someone who can help you partner to bring you a calm sense of getting all of your important documents organized and being financially prepared for a wide variety of economic situations. Next slide. And lastly, I would just like to wrap up with the circle of gratitude. Be grateful for what you have. Try not to worry about what you don't have as long as you have what you need. Try to find ways to expand your circle of gratitude on a daily basis. It becomes a self-fulfilling prophecy, and life just gets so much easier to live. So again, thank you for your time this morning. Jennifer, I'll turn it back to you.
Thank you, Laura. And with that, we'll jump right into our next presenter, Chris Casey.
Hi there. I was asked to comment on what to expect in the next 12 months. I'll answer that question right now. So the short answer is nobody has any idea. And I don't think anybody would put their careers on the line to basically say, here's exactly what you should do. But I think what we need to always, you fall back on is just fundamentals. I do know what's going to happen sometime over the next 6 to 12 months. The market's going to go up, down, or sideways. I mean, that's the short answer. So, but you do need to have some type of plan. So what I thought we would do is, because I answered that question very quickly, what to expect, which the answer is we don't know, but let's take a little history lesson. And our history lesson is going to start with a quiz. So if I could go to the next slide. So here's a quiz. So let me start with this. Everyone's entitled to their own opinion, but not their own facts. So when it comes to planning, facts better inform your decisions than your feelings do. So the purpose of this quiz, so if I were sitting in front of a client and actually have them go through this quiz, the purpose is for you to think about your opinions and compare them with the facts, because thinking influences your feelings and feelings influence your behavior. Fact-based thinking can lead to more optimal decision-making. So it's not about right or wrong. It's about a journey of self-discovery. So what I'm going to do is, what's in front of you right now is over the last 93 years in the stock market, I'm going to have you guess in your head, and I'll pretend like you were my client. Over the last 93 years, how many times has the market gone down more than 12%? How many times has it gone down but 0 to 12%? So we've had small losses, big losses bigger than 12%, small loss 0 to 12% loss. But then how many times over the last 93 years have we had small gains 0 to 12%, or big gains? And so the total, just because this is a 93-year study done by Ibbotson, is if you were my client, the most recent one I did looked like this. So go to the next slide. This is what my client said. My client said over the last 93 years, 20% it's gone down really big, and 20 times it's gone down really big, 30 times it's gone down really small. So that totals up to be 50 times this client thought over the last 93 years the market's gone down, which means 43 times the market's actually gone up. So they thought the market went down more than it did up. And so there, like I said, there's no right or wrong. It's kind of a hard question, but it's just your feeling right now. If I were to ask this question 3 years ago, 2 years ago, these answers for the same person would be different. So go to the next slide, please. This is actually what happened. If you take a look at the screen, the market went down, doesn't matter if it's big or small, 7 times and 18 times respectively. So for a total of, over the last 93 years, it's gone down 25 times. And then it's gone up 68 times. So about 7.5%, 19.5%, that's 27% of the time the market goes down. The remaining portion, it does go up. And if you'll notice, the majority of the time, over half the time, the market goes up more than 12%. Now, what I think the purpose of this history lesson is that over a period of time, the market does go up. We just don't know when it's going to happen. So therefore, I think one of the underlying themes of our brief chat here this morning is just that you need to have some type of plan. You don't need to have a specific product or specific stock to be successful. You need to have an overall game plan. People who have plans are going to reach their goals more likely than people who are just winging it. So I thought this little confidence quiz history lesson about the overall market is something good to go through now, because right now is not the time to do some type of knee-jerk reaction. If you have some type of plan, you don't do knee-jerk reactions. I've done this now. This is my 16th year of doing this. Once in 2008 and once a couple months ago, I've had 2 clients that did knee-jerk reactions. I didn't like it, But for me, I took it upon myself saying I just didn't lay out enough education for them, and maybe go through a slide like this saying that the market over a period of time does go up. You just have to be patient. So that's a kind of a long-winded way of basically talking about where do we think, what can we expect over the next 6 to 12 months? The short answer is we don't know. The greater question would be, what is our game plan? And right now our game plan should just be with what some of our previous presenters said before about creating some type of plan, sticking with it, no knee-jerk reactions, and really not trying to guess about which stock to pick or which sector to go into or anything like that. So that's, I guess, the majority of my comments this morning, because I know we were trying to leave some time for some Q&A.
Thanks so much, Chris. We really appreciate your insights here and taking a little quiz this morning. We do want to open it up for questions. And we had one question in the chat that was answered in the chat, but we also had some questions that were submitted ahead of time. And so I'm going to throw this out to our panelists. There were some questions about growth industries at this time. And I think our panelists had talked a little bit about, again, changing every day. But does anyone want to just address that briefly?
I can jump in on there. And I want to piggyback on what Chris was just saying, that it really is in the context of a comprehensive plan and a broadly diversified portfolio. When it's broadly diversified, there's going to be parts of the portfolios that are always going up and down at the same time. And the important thing is to be positioned well so that you've got consistent gains or opportunities for purchasing. When it comes to the times that we're in right now, the sector, and this is not a recommendation, but it's just an observation, is the consumer staples are the areas that are experiencing the most growth right now. In addition to that, technology is still a part of the equation. Healthcare is still a part of the equation. But if you just take a look at the environment and the things that are happening around us, there's a lot of places that have either laid off people or they're shut down. We've got record high unemployment. The economy is really at a stall, but there are some areas where people are still dependent, and these are the staples. So if you think about Johnson & Johnson and Kimberly-Clark and Walmart and Costco, and where people are going to spend money right now, primarily because they have to, and thank God the fear factor seems to have subsided, where we don't have madness happening in the streets around us anymore, but there are staples that people are still really dependent on, and that's where a lot of the spending is being done. That being said, the technology sector has rebounded quite nicely, and healthcare, of course, right now is a real interesting position, because obviously with COVID going on, there's a lot of stress, but opportunity in the healthcare sectors as well.
Thanks, Bob. Another sort of theme of questions here is in the, should I be making changes to my investment portfolio? I don't know, Chris or Laura, if you want to jump on that one.
I can jump in. That Bob mentioned this before. You might want to consider rebalancing, which might be a gentle shift in your portfolio. Any type of drastic move right now after the fact probably doesn't make a lot of sense. That's kind of like if you lived in a hurricane-prone state, waiting for all the sirens to go off, waiting for the hurricane to come, staying in your home. Halfway through the hurricane, you basically decide to leave. It doesn't make any sense. So again, it kind of gets back to the overarching theme of just having some type of plan. So no knee-jerk reactions, maybe some general rebalancing. That's what I've been doing with clients. Not a lot of knee-jerk, maybe just some subtle movements here and there, but no large swings.
One thing that I would add to what Chris has said, and I've used this with clients, I call it the SWAN philosophy, the sleep well at night philosophy. And again, in times of volatility like this, one thing, and it always comes back to what is your financial plan? And I think all three of us would agree. If you don't have the time, the skill, or the confidence to manage your portfolio, or you're looking to partner with someone, consider meeting with a fiduciary financial planner to determine if you've got the right mix for your risk appetite, your need for growth, the ability to meet your long-term and short-term goals, as well as your ability to weather different market conditions.
Well, thank you very much to all of our presenters. Again, my name is Jennifer Harmoning, and thank you to Robert Bayer with Stonebrooke Wealth Management, Laura Basballe from the Basballe Group Focus Financial, and Chris Casey with Casey Financial Services. We appreciate you guys taking the time to be here and to prepare for this as well. We have 2 more webinars this week. Tomorrow morning, we have a mental health topic. Let me see here. I think I have it. Oh, that was our thank you for today. And then the 4 responses to crisis in our lives is tomorrow morning. And then we have an update Friday on the state of healthcare and COVID-19. I'm also pleased to announce that we will begin our 3rd series of webinars next week with a back to business topic, readying your retail operation. And I think we'll have Bruce from the Retailers Association as our guest on that. So these webinars are provided in partnership with the Apple Valley, Burnsville, Hastings, Lakeville, and River Heights Chambers of Commerce. The recordings will be made available on partner websites for future view. And we thank you all for joining us this morning. Have a great Chamber of Commerce day.